Hello and welcome. US equity markets have hit a slight speed bump after an amazing 5-month bull run that saw indices recoup losses suffered in the earlier part of the year due to the COVID-19 pandemic. A sudden plunge in technology stocks has led to a correction in the Nasdaq Composite Index and to the S&P 500's worst 3-day stretch in months. Yet despite this, many analysts still believe that the US bull run has further to go. I'm Jonathan Peeris, one of the producers on CNA's Money Mind. And on this podcast, I ask the experts what their top 5 tips for investors are to navigate these market conditions. I have with me Kelvin Tay, Regional Chief Investment Officer at UBS Global Wealth Management, and Steve Brice, Chief Investment Strategist at Standard Chartered Private Bank. Gentlemen, welcome to the show.
Hi, Jonathan. Thank you for having me.
Thank you so much. It's lovely to be here.
All right, so let's first talk a bit about this rally that we've seen in the US markets. Now, it's been driven primarily by the technology stocks, the so-called FANG stocks. And no surprises there. I mean, these companies, Facebook, Apple, Amazon, Netflix, and Google, they've all thrived during the pandemic and the lockdowns and travel restrictions, etc. Their earnings have been strong and continue to be so. But another big factor driving the rally was the US Federal Reserve, the Fed, and their policy actions, keeping interest rates hovering near zero, and even their last policy announcement where Jerome Powell essentially said they're going to allow inflation to rise higher. Kelvin, let's start with you. How important has the Fed been in this US stock market rally?
So the Federal Reserve is, in essence, the commercial lender of last resort in the US economy at this point. Those actions have basically depressed bond yields, and they've actually resulted in deeply negative bond yields in the US right now on a real basis. And that in turn basically means that your equity risk premium actually widens quite dramatically. So that means that the equities market, despite the fact that it's actually run up so much, is still attractive on valuation terms relative to the bonds market. So that's the first reason. The second reason is that the run-up in the S&P 500 has not been very uniform. In fact, the dispersion of returns between the top few stocks and the rest of the index has been very, very wide. In fact, it's the widest in history. So in July itself, you've seen the big 5 stocks, or big 5 or 6 stocks on the S&P 500 actually run up dramatically, such that on a year-to-date basis, these 5 to 6 stocks are up about 51 to 52%, whereas the rest of the S&P 500 is actually down 7 to 5%. Right? So you can see that the dispersion is huge. It's basically almost 60% wide.
Steve, let's get you in the conversation now. This dispersion that Kelvin mentioned is basically a disconnect between Wall Street and Main Street. Now, how much of it is sentiment driven?
I think there is an element of sentiment, but actually, if you look at a lot of the indicators out there, so there's an investor bullish bearish index. It's not suggesting actually people are too optimistic, and maybe the tone of the conversation we're having here is like going, well, the economy's in such a weak state, the stock market's doing well. That's keeping people from investing. So you on the one hand you have the sort of Robin Hood type investor that clearly is embracing it, but the typical investor doesn't seem to be embracing it as much. So to us, this signs of people being a little bit cautious, a little bit skeptical, probably means that on a 6 to 12 month basis at least, the equity bull market still has some way to run.
All right, guys. So given this current market situation where things seem very hard to predict, what are your top 5 tips for investors on how to navigate their investments? Kelvin.
I think it's challenging because right now the proverbial low-hanging fruits have been plucked. Going forward, you need to be a lot more savvy. You need to be a lot more selective about where to invest. In the fixed income market, we believe that that's where a lot of the value is to be found because the Federal Reserve is really backstopping the fixed income market. And with that, we do think that the Asian high yield market, the Asian investment grade market is very, very attractive based on the risk return adjustment. We also like the US dollar denominated emerging market sovereigns with the refinancing of Argentina where their $75 billion debt is concerned. And that has actually removed a major overhang on the emerging market sovereign space. And we do think that the emerging market sovereigns are actually particularly attractive right now. We do like US investment grade as well. We do think that the corporates with investment grade rating in the US are still pretty attractive on a risk-adjusted basis. So that's basically the fixed income market.
Well, that's our first tip right there. Be selective. Fixed income is a tried and tested product. Steve, over to you.
So I suppose some of it's quite boring, right? Because it is being balanced. So don't just pick one stock and invest in it. Try and diversify across different asset classes, across different regions. Just try and play the long game here. I think that is really important.
In other words, don't just focus on the FANG stocks, right? I mean, they've been driving the rally so far, but honestly, how much further can they go, right?
Well, that's the billion-dollar question, isn't it? I think we are looking at FANG stocks that have had a lot of momentum behind them, and a lot of investors coming to it. Clearly, I think what we've seen is that the COVID-19 outbreak has accelerated a lot of things that were going to happen anyway. The question I think investors need to take into account is saying, if we were to project that going forward, will we see something, a step back from that accelerated trend back to where we would have been post-COVID? So if we get a vaccine, will people start, or change their behavior slowly back to where we were, and that could slow the momentum in these stocks. For now, it doesn't seem to be that way, but I think at some point that's undoubtedly going to happen, right? We can't see these stocks continually rallying at the pace they have done over the past 3-4 months forever.
So that sounds like it's our second tip for investors right there. Diversification is still the way to go. Kelvin, do you agree?
Absolutely. I'm not saying that you should sell all your holdings intact. Don't get me wrong, right? Again, the structural disruption that you've seen via this COVID-19 pandemic is likely to be there for quite some time. So what we're saying is that diversify. Diversify out of tech, or some of your earnings out of tech into value, cyclical, consumer discretionary. Or if you want to remain in tech, you can also diversify across tech, right, into the broader technology sector. Like, for example, your 5G related plays. Because 5G, the Chinese government is spending $1.4 trillion over the next 3 years to boost the nationwide capabilities of China where 5G is concerned. So there is a lot of capital there that is actually waiting for you to invest in. So diversify into the broader tech space, and don't just keep your investments in the 5 or 6 companies that have done really well this year.
All right, Steve, let's get back to you. What is your next tip for investors?
There's a big fear out there about what if I invest today and then the markets go down. So manage your emotions in that regard. I think it's really important to say, yes, markets might go down tomorrow. They might go down over the next 1, 2, 3 months. But if you look over time, investing relative to cash does much better. And indeed, if you listen to policymakers now, what they're effectively saying is, we want inflation above interest rates, and we want them actually above bond yields, government bond yields. That means that if you're investing purely in cash, in deposits, and also in government bond yields, you're likely to lose purchasing power because inflation is going up faster than you're compounding your investment. So you do need to look at that cost of being very, very defensive and try and take on a little bit of additional risk within your risk tolerance, of course.
So let's just recap. Our first 2 tips for investors are, number 1, be selective. Fixed income is a tried and tested product. Number 2, diversification is still the way to go. And now Steve has given us number 3. Manage your emotions and play the long game. Steve, what's your next tip for investors?
So we continue to favor China within Asia. So Asia is obviously one of our preferred regions, but China, both onshore and offshore. Part of this is the first in, first out. So the first into COVID lockdowns and the most severe lockdowns, of course, that we've seen globally. And then they've recovered quite strongly. So that element comes in. We've also seen a lot of policy support coming through from the authorities. And I think that makes sense, obviously, against the economic backdrop, but also in terms of the tensions they have with the US. I think they're very keen to keep some sort of support for the market in case companies want to delist from the US and relist either in Hong Kong or in China. So I think that's an element that we shouldn't downplay. There is a sense of margin buying, so buying on leverage buying of equities has picked up quite significantly. So we need to keep an eye on that. But at the moment, we're sort of 30-35% below the levels we saw at the last peak in terms of margin financing. So we've still got some room to go before that becomes a challenge.
All right. So the fourth tip is basically look beyond the US. Asia, for example, remains positive. Kelvin, do you agree?
I think Asia in general is healthy because of the fact that we have the dollar weakening this year. The dollar is actually weakened from 1.08 in March to about 118, 119 as of now. And whenever we have a debasement of the dollar or a depreciation of the US dollar, that in turn has always been very positive for Asian markets. Whether it's bonds or equities, it's always been positive. There is this very strong inverse correlation between the two. The markets that have done well in Asia are basically Taiwan and China, largely because these are very tech heavy. China, for example, about 50% of MSCI China is now very tech related, even though a large part of that is considered consumer discretionary. But even the consumer discretionary stocks are built on a tech platform. And of course, where this COVID-19 pandemic is concerned, it has basically accentuated the reliance that consumers in China and in most parts of Asia have on the tech platform. So that has actually been very positive for the tech companies, both in China and in Taiwan, but for very different reasons. Taiwan is basically hardware oriented, and because of this COVID-19, because we have to work from home, we have to study from home, that has actually resulted in a surge of buying for computer-related peripherals and equipment. If you have a family of 4 and you're locked down, you need to have 4 computers, not just 1, because everybody needs to be studying and working in the same hours.
And on to our last tip for investors. And Steve, you mentioned it before. Don't fixate on equities. Look to other asset classes, correct?
So actually, yeah. So, we would say we like credit. So effectively corporate bonds. So not US dollar bonds not issued by the US government effectively. So our 3 areas of preference are high yield in the US. Obviously, people that sub-investment grade or junk bonds. So it is there is significant risk involved. But if we're right and we think that the default cycle is going to be relatively managed in the US, that should continue to do well. They look relatively cheap to history. And then in the emerging markets world, we like emerging market US dollar government bonds. Yield, again, pretty attractive as long as you don't see a spike in US government bond yields. That should do pretty well, especially with the weak dollar environment. And then if for more defensive investors, Asian corporate bonds offer a relatively attractive yield relative to, say, similar rated companies in the US. So it's a pretty low volatility asset class. High exposure to China, but that hasn't seemed to hurt it at all. In fact, if anything, it's helped it. So that's a sort of more defensive area within bonds, but you can get over 3% yield and still be relatively defensive.
And that just about brings us to the end of the podcast on 5 things about investing during a pandemic. Just to recap, number 1, be selective. Fixed income is a tried and tested product. Number 2, diversification is still the way to go. Number 3, manage your emotions and play the long game. Number 4, look beyond the US. Asia remains positive. Number 5, don't fixate on equities, look at other asset classes. Now, I've been speaking with Kelvin Tay, Regional Chief Investment Officer at UBS Global Wealth Management, and Steve Brice, Chief Investment Strategist at Standard Chartered Private Bank. Thanks, guys. And thank you for listening to the 5 Things You Need to Know podcast by CNA's Money Mind team. Tell your friends about us on social media and catch us again next time. Goodbye for now.